Bring that ass back like a boom, 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 boom.
Hey folks, this is the second part of the video for this week's market overview, and I want to start with a chart of the 2-year-old US Treasury yield. We've been monitoring the 2.0 level. We blasted through it. Now we're at 230. Then I also want to show you the 10-year-old US Treasury yield, which also blasted through the 2.0 level that we've been watching, and now it's 248. And what I'm showing you this chart is basically the third chart, which is the most important one, and this is the 10-year-old minus the 2-year-old US Treasury yields. Some use, instead of the 2-year, they use a 3-month Treasury yield chart. But the idea is the following. Once the 10-year minus the 2-year or minus the 3-month gets to negative, so they're basically subtracting the value of the 10-year minus the value of the 2-year. And as you see in the examples, so we have 230 for the 2-year and we have 248 for the 10-year. So we do 248 minus 230 and we have 0.18. Now, once this curve inverts, meaning goes negative, which most people refer to negative yield curve, then it is believed that this is followed by a recession in the market. Now, I'm going to leave a link to the paper that basically talks about how to understand what's going on, and this is the paper that most of the analysts are basing. They are thinking that the market might top and we might go into a recession once this curve becomes negative. Now, the paper is 45 pages long. It's absolutely free. I'm going to leave a link so you can download it from the official source that it's holding right now. The paper is basically, well, it's a paper. The title of the paper is "The Predictive Power of the Yield Curve Across Countries and Time." It's written by Menzi Chin and Kavan Kuko, and you can read the whole of it, but I just want to give you some thoughts about it, so you know what to how to read it, and you know what is going through my mind when I'm reading it. So now there are some things that you need to know. Now, the first thing that is very important and that the paper doesn't deal with is the slope of the yield curve. And this is something that in the past has not been monitored very well, but right now it's done properly. And the yield curve itself is not as important as the slope of this curve. So since we have had the habit of monitoring that slope for the past 10 years, this might a little bit reduce the forecasting power. So the Feds are actually in control and knowing what to do and how to basically go with their policies according to the slope of the yield curve. So don't take everything the papers say as 100% gold, and really when this yield curve goes negative, then we have recession. This is far from the case. There have been some other studies that have been shown that through inverted curve yields, we've actually had rallies, and the market is actually slow to respond to this as being an indicator, so don't use it. The second part is, as I said, the second problem, the second caveat that I have with this is that there's an issue with timing. So the yield curve really actually may invert way before a recession, and the recession might come at a later point or might never come. And also, the other thing that you might have in mind now, well, if everybody knows that the inverted once the curve inverts, it's followed by a recession, then we're going to take measures. So this is the other thing. I mean, we know that history has shown this, and I think we are smart enough now that we can take some measures as a result of it. And the third one, there are some nuances. So you need to you need to monitor closely how you measure the shape of the curve and how deep of an inversion. These things are still up in debate. I mean, if a stock rally is 100%, it's one thing, but if the stock rally is 2%, it's another thing. Although it's above the resistance zone that you're thinking it's critical. So all those things are important when you think about the inverted yield curves and what the market will do. So anyway, as I said, I'll leave the link for this article in the description of the video, so you can download it and read it at your free spare time. And now, since we're on the topic of Feds and rate hikes and yield curves, I want to go a little bit into depth about the rate hikes and how they affect the market. So this is a chart from Fed. This is the federal funds effective rate. You can see on the bottom right corner here where all the charts are coming from. So if you're interested, you can visit this resource. It's absolutely free. They have a lot of stuff that's related to the Federal Reserve monetary policy and charts. Now, the first thing I want you to see here is the white spots basically are the times where the rates have been hiked. So every time the rate has been hiked, you can see there's like a huge white window right here, and then there's some declines that you can see right here in the shaded areas. Now, pay closer attention to this chart, and let me show you another chart. So this is starting from last century, 1955, and this is the S&P 500 from arguably 1955. And as you can see, there are also some shaded areas. These are the drops in the S&P, and then there's some white areas, which are the advances of S&P 500. Now, as you can see here, we have these shaded areas and again the white areas. Now let's make a comparison between the two charts side by side. I'm just gonna put them right here, and we can start if you want from the upper right corner right here, and you can see that the Feds actually did raise the rates going into 2005, going into 2010. They actually raised the rates, and look at what the market was doing. The market was going up. Wasn't going down, it was going up. Then the market went down and the rates went down. Prior to that, we also had one rate hike from 1990 to 2000. It's been going up, and from 1990 to 2000 the market's been going up as well. And if you pause this video at this exact second and start comparing the shaded areas which indicate rates dropping, you will see that every single time that the rates have been dropping, the market has been dropping. Quite conversely of what people are actually talking, and this is the reason why I'm telling you, you should not be spooked about the fact that the rates have been hiking. It's not a bad thing as most people are trying to represent it. And to further solidify my statement, here is some information from the Dow Jones Market Data Service, which can show you the performance of the three major indices. They don't have the IWM right here, but you have Dow Jones, S&P 500, and NASDAQ during the rate hike cycle. So from February 1994 to July 95, the Dow Jones returned 16.3, you see the NASDAQ returned 18.1, and so forth and so forth. From March to September, another rate hike, NASDAQ returned 40%. The only negative, since they've been tracking this, the only negative period has been from June 1999 to January 2001. And this has been the only negative area during rate hike cycle. Every other period through which the Feds have been hiking the rates, you've seen astonishing returns. So the rates are not something that you need to worry about. As we try to stress on our Discord channels, we focus on the setups, we focus on the stocks. If there are setups and stocks that we can trade, we are going to trade them. All these indicators and market internals and charts that we're going through for the indices, they are some sort of a post guides to actually allow us to understand the market a little bit better, but they're nothing more than that. You are actually not trading the rate hikes, you're not trading the VIX. Well, you can actually trade the VIX, but you're not trading stocks above their 200-day moving average. You're not trading put call ratio, you're not trading advanced decline lines, none of that. You're actually trading the stocks or some derivatives of stocks like options and so forth. So you need to pay closer attention to your stocks and worry about the market a little bit less. That's the only thing I'm trying to actually, guys, show you here so you know what we're looking for. And since we're done with the Feds, we're done with the hikes, with the yield curves, and so forth and so forth. Now let's take a look at something that's a little bit more interesting, a little bit more pertaining to stocks, and these are the top and bottoming industry groups. Looking at the top industry groups, there's not much of a difference since last week. We still have energy-dominated group rotation in top industry groups. We have 1, 2, 3, 4, 5, 6 of 10 oil and gas related. We have also energy coal on the second spot. We have chemicals and agriculture, and we have steel producers in mining, metal ores also coming into play. And that's pretty much a direct result from the geopolitical tensions. There's nothing more to it, there's nothing less to it. However, be careful because most of those stocks are vastly overbought, so there's some expectation for a correction due. In terms of the notable group movers to the upside, I like to do this, and again, this is not saying that these groups are top groups. This sort of an indication is just measuring the move from last week to this week performance of the group. So for example, there are 197 groups, and you might have one of the groups that fall into this category of notable movers to the upside. For example, it was 180 last week, and now it moved to 120th spot. So it moved 60 spots to the upside, but it's still 120th in place. So be wary of this. The other thing I wanted to mention here is that these are the top tickers as per Investors Business Daily Market Smith platform based on earnings per share and sales growth. So these are not my recommendations that you should trade them, nor it's a recommendation for you to go ahead and consider them even. I'm just saying that these are the tickers that Market Smith have selected as top industry group representatives. They are not filtered by volume, so they might be very shallow names. Some of these names that you will see in the parentheses, they are traded OTC, something that I don't really like, I don't do. So be careful of the names. Of course, some of the names are really high growth, really large cap names, and you will see them here. In some of those names, we've taken positions based on the fact that the industry groups are showing very high relative strength compared to last week. So let's just look at them. You have agricultural operations. BG is my one of my absolute top favorites right now in this current market conditions. In my personal account, I've purchased that during this week. We have CTVA. Telecom consumer products, Apple made a huge move. The other four tickers, I admit I don't even know them. Utility electric power, you have PAM and we have FE. AEP is on my watch list. We have retail drugstore, CVS. We had the Boom portfolio. We had a small position in this one as well. ATSG from Transport Air Freight, UPS, FDX, of course you know them. Energy Solar, I mentioned them in the chat room. SEDG is one that I'm definitely looking for. ENPH already moved higher. As far as computer software security, PANW is the ticker that I was watching. FTNT is also a good company. Auto manufacturers moved higher mainly because of what Tesla did, but you have Tesla, you have Toyota, you have Ferrari, which tickers I always liked Ferrari ticker. Unfortunately, the stock itself is rather gappy, so it gaps up, gaps down, gaps up. Really hard to trade, but I really like. The ticker communication services, document management. I think we took a position in IRM. And last but not least, computer software gaming. That's Nintendo right here, and they have ATSI, which is Blizzard, and EA, Electronic Arts. So basically, these are the companies, the industry groups that have moved the most to the upside from last week to this week in terms of relative strength for the entire group. Now, the worst industry groups, not much of a change again, mainly computer and apparel dominated. Now we have finance and credit cards coming in right here, and you will see when we are doing the notable moves to the downside. You'll also notice here that we have bank super regional. Now, one thing to remember is that we spoke about the inverted yield curve. One thing to remember is that the banks and the banking industry sector are the ones that will suffer the most from such an inverted yield curve. Reason being is very simple. If the short-term yields are more expensive than the long-term yields, the banking business in general will suffer, because what they actually do is that they count on purchasing lower-priced short-term yields and lending out longer-term, more expensive yields. But when this inverts, and basically the entire business model for them is screwed. So banks will definitely suffer from an inverted yield curve, and I'm expecting more of the banking institutions to actually start showing some relative weakness. The other ones that you can see right here, we have building wood products, leisure and lodging, media, radio, TV, transportation, truck. JB Hunt is one of a notable company right here, and you remember a couple of weeks, maybe a month ago, we were talking about MAR and HLT, which is Hilton, setting up to the upside. WH, we were actually stopped out of this position, and now they're moving downwards in terms of relative strength. We also have tobacco, MO. I had a personal position in this one. I closed it at profit, but it was moving up and down. PM, Philip Morris, also not a good company to trade right now. We also have like building construction products. A notable company here is BLDR. It was setting up nicely, then it took a little bit of a hit. And last but not least, retail and wholesale of automobiles. So cars, PAG, GPA, and this Rouge A and Rouge B. I guess these are OTC stocks, so I'm not really familiar with them. So in terms of sentiment, let's start with the bulls. And bulls jumped pretty much about 10 points from 22 last week to 32.80 right now. And that definitely goes to show that the bulls are stepping up into the market. And as we see in terms of the bears declined more than 15 points. So bear sentiment is definitely taking a beating. Bears are less right now, but still, if you look at the balance, we have bulls at 32.80 and bears at 35.40. So bears are still more than the bulls. So we're definitely not even into balance, and we're still not out of trouble. Although we had some rallying in the market, I think we should still be careful in how we trade and be a bit selective in our setups. Now, I usually proceed with CNN's Fear and Greed Index, but unfortunately, as I'm making this video, their web page is down. It has been so for the last 1 hour. So if this resolves itself, I will definitely post the screenshots of the Fear and Greed Index and its components in our Discord channel for the users to see. If not, you can do it on your own sometimes during the week. Definitely last week we were still fearful. I believe it was 32 if I'm not mistaken. The index definitely above 50 right now, so we're going for optimism levels, and that's just my guess, knowing what they include in the index readings. So now let's jump go to crypto, and in terms of crypto, the Fear and Greed Index now is almost at 50. Last week it was, I believe, 32. So we jumped another 17 spots, and definitely, as you can see, what really is interesting for me is that we are not still at the optimism levels, and although Bitcoin moved about $44,000 already. So that's good. In general, if you have noticed, extreme optimism usually is a topping indicator, so it definitely shows that the market has reached a level which is unhealthy. And when we have a lot of bearish sentiment, or the bulls are lacking, so to speak, we have basically an indication that we might be bottoming. So this is pretty much a good picture right now that there's still a lot of space for moving to the upside when we're talking about crypto, and I already shared my opinion about crypto, thinking that it's been performing much better than Nasdaq Composite Index. Now with this, I want to go into the summary and finish the market overview for this week. Our risk vest model moved to positive. The stock setup is still selective. I'll be careful, as I said. We've had 4 days in a row with more than 1% rallying for the S&P 500. That hasn't happened, I think, in the last 70 years. So this alone might suggest either extreme strength from the bottom or some temporary topping action. So be careful what you're buying. But as I've put it on at the bottom right here, be brave but think risk first. So I definitely believe that you should think risk first all the time. And now is the time to show some bravery and get into some stocks, because if this is the bottoming action, you would want to be early in. As far as the market is definitely rallying right now. Put volume has moved to a more bullish level, so it's going down. I am hoping that it will stop at about 0.75, as I mentioned in the market internals. But anywhere to 0.5 is okay. Anything below 0.5 becomes really worrying for me. Too many calls, too few puts, and we're prone for a reversal. So, but still, we're at 0.76 right now, so there's nothing to be worried about. Volatility is decreasing. You see all VIX almost hitting the 20 level. If we move below 20, that definitely indicates that the market is healthy, and a steady raise would be something that I would expect. And the other thing that we want to mention is geopolitical tensions. They continue. Nothing is resolved on the Russian-Ukraine conflict. However, rates they prove to be a positive catalyst for the market right now, and more than rates, the fact that we already know what the Feds are thinking and what they're doing is something that definitely puts the market at ease, and there's some calmness in that sense, at least, because we know the Feds can definitely move markets. So that's it for this week. I hope you enjoyed. I hope you enjoyed what we are bringing in terms of content to you. If you like it, guys, please subscribe to our channel, hit that like button, and leave the comments in the comment section below. Also, join our Discord. This is where all the action is happening. We are definitely putting on more and more stuff for you. So again, as I said, if you like it, hit the subscribe button, like it, comment, join our Discord, and I'll see you guys next week with another Market Watch overview. See you guys.